Welcome back everybody to the Andy the Banker Show. This video is mainly for brand new beginners, people who are starting out. They have been investing for maybe 1 year or 2 years or even less than that. I want to share with you my journey on how I learned about investing and go from there. Currently, I have a 4 stock portfolio and I want to go over some certain beginner things that I believe everybody should know. So let's take a look at, for example, a company like Microsoft. Now, when you look at a company like Microsoft, you're going to see a couple things here. First thing is your average cost, right? This is essentially the cost that I bought Microsoft at. Now, I bought Microsoft cheaper than this. I bought Microsoft more expensive than this. However, on average, each share, I have 74 shares of Microsoft, and each share has been bought at $338. Currently, the stock is trading at $436. So as a result, I've gained a total of $7,289. So that's what the average cost is. It essentially tells you, are you making a capital gain or a capital loss? A capital loss would be if this number is negative. Let's say I bought Microsoft at 338, and let's say the price of Microsoft is 300. I'd be losing essentially $38 per each share I have. That's very important. Another thing is portfolio diversity. This part here, 55%, it's essentially saying that out of the 58,000 I have invested, 55% is in Microsoft alone. That's what the portfolio diversity means. That is very important. It tells you how concentrated you are in this particular position. Now, this amount, I am 55% invested in Microsoft in this portfolio. This is something that I would consider is heavily concentrated portfolio. Most investors do recommend for a diversified portfolio where you have like less than 10% for each stock. Now, if we go down, it tells you how much employee they have, who is the CEO, and we come to the market capitalization. So market cap of the company, it's currently at $3.24 trillion. Like, what does that mean, Andy? Essentially, if you wanted to buy Microsoft, that is how much the whole company is worth. It could be worth more than that if more people buy into, but essentially at this current moment, the valuations of Microsoft is $3.24 trillion. Certain things that I really look for is a 52-week high. Like currently, I want to look at is it in 1 year, the highest is trading is 468. Is it trading at its highs or its lows? So right now it's 436. It's about $30 below the 52-week high. That's important to know as compared to if you're buying it at the lows of 52 weeks. So in the last year, it was trading at 309. That tells you how big of a range that Microsoft does trade in and how volatile the stock is. And then we look at the dividend yield here. Now, the dividend yield is important because dividends are essentially excess earning that the company has. So in this case, Microsoft has an extra money they make from customers, and they're going to pass that extra money along to us. So let's say you have $10,000 invested in Microsoft. Within 1 year, you're essentially going to get $69 from Microsoft for that $10,000. So that's to me, 69% yield. I don't essentially trade just because of the dividend yield, but I do appreciate any dividend yield a company does give. And then one of the very important ones is price earning ratio. So not always, but on average, the higher the PE ratio typically means the more expensive a company trades at. Now, certain companies typically trade at a higher PE ratio as compared to others. Like, for example, Microsoft is trading at a 36 PE ratio. It's within range. It usually does from 32 to about 38. That's what I typically see Microsoft trading at, as compared to, for example, let's say like an AT&T. AT&T, off the top of my head, should be like below 10, I'm thinking. It usually has a very low PE ratio, a company like AT&T. Now, typically, the higher the PE ratio, those companies tend to be the growth companies that we believe are going to grow into their valuation. Like, for example, a company like Coca-Cola, we typically have a pretty good idea of how much Coca-Cola is going to earn year over year. Like we have the same amount of people that drink Coca-Cola in 2024, typically the same amount of people that drinks Coca-Cola next year. Like no matter what happens, if we have a bad economy or a good economy, they're typically the same amount. The people that don't want to drink Coke, they're not, they're not gonna touch it. And the people that love Coke, they drink it every day. They're gonna keep on doing it. So we have a pretty good idea. It might be off just by a little bit, but the companies that have a very predictable earnings, they will have essentially a lesser of a PE ratio as compared to somebody that could essentially outperform it. Like with Microsoft, there are the thesis that the AI could really change the company and make it become even bigger. So as a result, it results a higher PE ratio. Now, the next thing I do want to discuss about the companies is that when you go down to on Robinhood specifically, they talk about a couple things here. First thing is economic moat, and it says it has a wide moat. What is an economic moat? A moat, if I were to give you an example, essentially moat came from the word castle, where castles, if there is, for example, how hard is it to get to the castle, right? In this particular case, how hard is there a company to take over Microsoft business? It'll be very difficult. Like you can't just start another Microsoft next year. It's very difficult for a company to do so because there is a lot of infrastructure costs to get there as compared to, for example, let's say you started a restaurant business. You can easily start another company can create a restaurant business and take over that business. The economic, you want to be investing in companies that have a wide economic moat where somebody just cannot just come in and steal your business. A company that has a wide economic moat, for example, Microsoft. I'm thinking about a company like Apple. It's difficult to come in, even though you have a better phone than an Apple, right? Because the moat of Apple, because of all the ecosystem that Apple has, the headphones, the Apple Watch, even though somebody else makes a better phone, it's difficult for customers to switch over to that new phone just because their moat is so darn strong. I'm thinking about another moat is like a Costco, right? It's difficult for companies to just start another Costco. There's so much investments that you have to make, so much infrastructure you have to make that no company can essentially come out next year and say, hey, you know what, we're going to have the same Costco business model. That's very important. I always look for companies that have a very wide moat. The four companies I invested: Microsoft, Costco, Google, Chipotle. Now, out of the four, Chipotle has the lowest moat, where there's another company that can make a burrito business, but it's difficult for them to sell it at the same price that Chipotle sells right now. Chipotle burritos, especially in my area, is about $10. It's difficult to have that type of traffic. Now, in terms of uncertainty, how predictable is the company's earning? When you think about a company like Microsoft, you look at their charts, essentially their revenue charts, to me, it says here it's medium. For me, they are a very predictable company. You look at their earnings just year over year, they increase their revenues, increase their cash flows year over year. Now, this year, I can see why they said medium, because they're having a lot of expenses on AI. Right? When you have uncertainty, we don't know how AI is going to pan out. AI can be a big hit, where a lot of these companies want to use Microsoft services, or we could have the AI be a bust, where Microsoft spent a bunch of their cash flows into AI, and it doesn't pay off, right? Or they lose the race to somebody else. Maybe Google comes in, takes over their AI business, or Amazon comes in, takes over their AI business. Now, when it comes to stewardship, this one, although to me it has the least impact, but it is a strong impact on the company. It's essentially, how is the company managed? Who are the CEOs? How is their leadership team? And when it comes to Satya Nadella, he gets a reward of exemplary. I agree with that. He was able to turn the company around. Essentially, any decision that Satya Nadella seems to come with, I'm on board, because he has proven himself with great decision after great decision. That's why I trust him on this AI play. Right? He has made the decision to push forward for this AI play, push forward on investing in OpenAI, and based on his past performance, I'm very happy with how he is taking care of Microsoft. Now, if I were to buy Microsoft, these two are the biggest one that I use. Buying order is if I were to make a buy order and let's say bought a 50, I can't buy right now because the market is closed. It's currently 1:17 a.m. for me here in San Francisco. However, buy order, let's say you put a buy order, you're trading at the whatever the price that the market is trading at. So if it's happens to be trading at 437, the market's going to execute it at the fastest price. That's a market order. However, if you put a limit order, for example, I switch that to a limit order, I can put a price in. With this, I can say, you know what? I want to buy Microsoft instead of 436.59. I want to buy it at $435. And the moment it hits $435, I'm going to trigger a buy order. That's what essentially a buy limit order is. When I start investing, I typically like to do a limit order so that I can pick what price the trades execute at. All right, I can buy 2 shares and it specifically tells you. Now, in case you might be wondering, am I telling you to buy into Microsoft, Google, Costco, Chipotle? Absolutely not. The best way I want you to start investing is start small. Every investor makes mistakes at one point. Even Warren Buffett, he's one of the most well-known traders that I know of, and even he makes mistakes. For example, he sold Costco back in 2020. That was a mistake, right? So the main reason is when I want you to start early, make those risky plays early, you can learn so much. If when I started investing, I started with like $100. All right, just $100, and then I picked whatever stocks I wanted. I picked J.P. Morgan, Wells Fargo. What else did I pick? I picked Visa, and then I waited 6 months. I saw how I invested, and I learned from my mistakes. What do I mean by that? For example, I look into my Chipotle stock. All right. I bought this stock 50. It's currently trading at 57.31, but I bought Chipotle at $57.60. Now, if the stock goes down 20%, 30%, let's say it goes down to $40 per Chipotle share, I would have lost a lot of money. But my thought process as an investor is, wow, I get to buy this stock at even a cheaper price. I get excited about that. But that's the way I think about investing. Not every investor is going to think like that. There are other investors who might think if it falls down to $40 or $30 that, oh my God, you guys, I think I made a huge mistake investing in Chipotle. I think I'm going to sell out now because I don't want to lose more money. You got to find out what type of an investor you are, right? Because there's many different type of investors. I'm typically the type that when I choose a stock, I think to myself, if the stock price goes even lower, why wouldn't I keep on buying more of that stock? And that's the type of mentality I have. Now, in terms of investing, we all have one goal. All right. Most investors have the one goal of beating the S&P 500. That is so very important. And you might be wondering, what is the S&P 500 and why does it matter? If you take a look at my 1-year chart here, all right, my 1-year chart, I am 29% up in past year. Out of that, I am up 13,000. This 13,000, I did not have to work at all. Like this 13,000, my money did the work for me. My companies did the work for me and they built my net worth. Last year, exactly, I was at $45,000. This year, without doing anything, my companies have gained me $13,000. But how can you know if I'm doing good or not? You might be thinking, wow, Andy, you're up 29%. You're doing amazing. Not exactly, because we don't judge based on your performance. We judge you based to the S&P 500. All right. Now you might be wondering, what is this S&P 500, which is essentially our Standard and Poor 500 ETF. Now, with this Standard and Poor, this is what we judge on how well of an investor you are. And S&P 500 are our biggest 500 companies in the US. All right. You're going to see companies like NVIDIA. You're going to see companies like Microsoft, Apple in there. You're going to see Tesla in there. You're not going to see smaller companies like Celsius. You're not going to see smaller companies like Rivian. They won't be in the S&P 500. But if you look at their S&P 500 1-year chart, it is 30%. All right. So even though I did at 29%, we judge our investment portfolio based on the S&P 500. And currently, I am underperforming S&P 500 by 1%. And as a result, I did not do as good as the S&P 500 this year. Now, what we want to judge, I am still doing my own portfolio because over the long term, we are making the bet to beat the S&P 500 on the long term. All right, 5 years, S&P 500 is 91% up. This current portfolio in Robinhood, this is only 2 years old, so unfortunately, I do not have a 5-year chart. Something that is very important about the S&P 500. So this is something we use as a benchmark. When you hire your financial advisor, we want to know if the financial advisor can beat this S&P 500. Because if they can't beat it, might as well just invest in the S&P 500 itself. Right? That's the thought process in it. It's like, why am I paying a fee to a financial advisor if I can just buy the S&P 500 itself and let it do their own thing. Now, S&P 500, when you invest in index like this, something really interesting that you got to keep into account, all right, which is that with an S&P 500, it tells you what sectors that it's into. One thing I do love about S&P 500, it allows you to diversify so much easier. For example, 32% is in technology stock. That would be like the Apples, the Microsoft, the Amazons. 12% in financial service. That would be like the Bank of Americas, the Visas of the world. Healthcare, 11%. That would be like the United Healthcare. It tells you how it is diversified, and also tells you the top 10 holdings within the S&P 500. Think of S&P 500 like this. The best analogy I use it is, imagine you go to McDonald's. All right, you go to McDonald's. You can order the Coca-Cola. You can order the drinks, the sandwich, and the fries by itself, or you can order a combo meal. All right, so S&P 500 is essentially the combo meal. They're basically giving you everything in one price, right? Instead of you buying the French fries by themselves, the sandwich by themselves, it gives you one simple plan, and that's why so many people love it. Like it's a combo meal, and however, for that combo meal, S&P 500 is going to charge you. All right, the fee is not a lot, but there is a fee for essentially index funds. Not all have it, but a big chunk of them do have expense ratio. So for example, right here, expense ratio is 0.09. So what does that mean? So for example, if you invested $10,000 into the S&P 500 per each year, it's going to charge you $9. And that's, to me, it not too crazy. It's very normal. But different indexes will have different expense ratios. So always keep out for the expense ratios because they do eat into your returns. Now, one quick thing I did want to point out about S&P 500 is when you look at the shares here, I have less than one share. And you might be thinking, Andy, how is that even possible? There are certain brokerages that will allow you to have fractional shares. A fractional share is essentially that you have fraction of a share. So you don't have the full share, but you can buy into. So for example, my value in S&P 500 I have in this portfolio is $24. Each share of S&P 500 is 568. So I have only $24 of it. So that's essentially 0.04 of a SPY share. And I didn't want to notate here as well that even when you have a SPY share, you also do get dividends as well, even though it's fractional. Now, one fun fact about the S&P 500, when you're an investor, this S&P 500 is going to come up over and over and over again. Because again, this is what we use as a benchmark. This is how we judge you as how good of an investor are you. Now, something that's very fun fact about S&P 500 is that the last 40 years approximately, it's given you, with dividends reinvested, 10.51%. That, like, if you invested in S&P 500 since 1971, you would essentially year over year, your money would be on average grow by 10.51%. Now, does that mean that every single year the S&P 500 is growing by 10.51%? Absolutely not. So to give you an example, let's say, for example, 1 year you get 20% return on the S&P 500, and then another 10%. But then on the third year, you could have a negative 15%. Right? But on average, if you add all of those returns over time, they end up being around 10.51% over time. To recap, as a beginner in the stock market, the way I did it is I chose whatever companies I wanted to invest in, companies that I believe were going to increase their revenues and cash flows the next year compared to this year. And from there on, I I I didn't put a lot of money. I put just a little bit, right? 500, 100, and then waited 6 months and see how I performed. See, not how I performed essentially, but see how I reacted when my stocks went down. Because not every stock will go down. You're gonna have certain stocks that certain days where your stocks are not performing too well, and you want to see how do you react in those particular cases, because that really tells you what type of investor you are. And from there on, you can pick your type of stocks, because there will be certain stocks that have high volatility. So when I say high volatility, meaning like an Nvidia, where Nvidia can go up in stock price 25% up or 25% down in a single week. Or you can have companies with lower volatility, like Johnson and Johnson, where their stock price doesn't really move that much year over year. But you want to determine for yourself, because each person is different and each person is going to invest differently. That is all for this episode, you guys. Thank you so much for watching. If you guys had any questions, please feel free to enter that in the chat. I'd be happy to answer them in the next video. But that's how I started getting into investing. As I got more comfortable with investing, I was able to find the right type of portfolio for myself. But for a beginner, I made my mistakes. I learned from my mistakes. And this is the portfolio that I came to after learning all my mistakes. And I'd rather fail early on when I don't have a lot of money than, let's say I have 58,000 and I make a huge mistake at this dollar amount. Alrighty, you guys, thank you so much for watching. If you guys have any questions, again, feel free to leave it in the comments. If you could like the video, that helps out a lot. If you've learned something new, and if you're interested in my other videos, I also post on TikTok as well. And see you guys on the next video. Thank you very much.